Good afternoon, everyone. This is Entrepreneurial Management, and I am Miss Hannah Grace Ibonya together with Miss Russell May Batistis, and we are going to talk about managing finance in a business. Managing your business finance is critical to keeping your business running smoothly and making informed decisions. Ignoring your small business financials could mean losing out on valuable tax deduction, having problems getting loans, and making business decisions that create more problems. Yet, managing personal finance is different from managing business finances. Managing personal finance requires budgeting of earned money or salary, saving, investing, paying debt if has, allotting emergency fund, and all of that falls under planning. While managing business finance requires income monitoring, strategy evaluation, asset diversification, profit optimization, dividend decisions, and capital investment. According on a website, financial management is organizing, strategic planning, directing, and controlling of financial undertakings in an organization or an institute. It also includes applying management principles to the financial assets of an organization, while also playing an important part in fiscal management. There are objectives involved in financial management, and it includes the following: maintaining enough money supply of funds for the organization. So when starting a business, it is important to have a backup fund to support the business. Without generating adequate cash to meet its needs, a business will find it difficult to conduct routine activities such as buying raw materials, paying suppliers, and paying its employees. So a business should have always sufficient fund if any dilemma comes to the business. So it is one of the major objectives in financial management. So next objective is to ensure that the shareholders get enough return on their investment. So as part of a growing business, a shareholder is like an owner. It also has an important role like governing and giving various ideas for an organization to perform well. So it will reflect on the business. So ensuring that they get a profit on their capital investment on the business will make them happy and success will remain in the business. It will survive and attractive to other investors and possible clients. Next is optimum and efficient utilization of funds. So to ensure optimum funds utilization, once the funds are procured, they should be utilized in maximum possible way at least cost. So finance is the lifeblood of any organization, even though it is small, large, profitable, or non-profitable. It is therefore extremely important that the finances of the organization are managed in the most efficient and effective manner to ensure the long-term valuability, sustainability, and profitability. So optimum and efficient utilization of funds is important because effective and efficient fund utilization enables organization in profit and wealth return maximization, minimization of the cost of capital, improving savings, and bettering its value. When funds are optimally utilized, it will help the organization grow and flourish in the long term. Create real and safe investment opportunities. When doing our planning to start a business, one of its financial management objectives is to create real and safe investment opportunities for the shareholders and clients. So no one wants their capital to get lost. So ensuring to put the capital on a safe ventures will increase the possibility of a successful return or profit. Investment decision can be simply called capital budgeting decision. In a large companies that operates daily like factories, one example of investment decision is buying machineries for production. That investment decision has a good effect on the company's long-term earning. While in a small-scale businesses, short-term investment can be classified as cash, inventories, additional capital, and many more. So, investment decision refers to selecting and acquiring the long-term and short-term assets. Just like the investment decision, working capital management decision is also important in making financial decisions. This responsibility includes managing a company's short-term assets and liabilities to ensure that that it has adequate cash to satisfy its obligation. This also includes inventory management, accounts receivable, and accounts payable. In a financial decision, some sort of important decisions include first, investment decision. So as discussed lately, it involves initiatives deciding to invest in a long-term or short-term investment. It's either machineries or inventories, anything that can help the business be profitable. Risk management decision is also important in making financial decision. If there is an opportunity, there is always a risk. It includes recognizing, measuring, and managing a company's risk. The decision about risk management must take into account our consideration from both the potential impact of hazard and the cost of reducing the risk. When we say dividend, it is the sum of money or reward that has to be given by the company to its shareholders. So dividend decision is how much of the business net profit is to be distributed to the shareholders and how much of it should be retained in the business for for meeting the investment requirements. So there are factors that affecting dividend decision, and these are amount of earning of the business, stability in earning, stability of dividends, cash flow possession, and shareholders' preference. It is the factors that affecting dividend decision. The major function of financial management in a business is to help the firm or the institution or the business to maximize profit, liquidity, and earnings per share, and also to manage the risk and avoid major problems regarding business finances. One of the function of financial management is the estimation of capital requirements. So a financial manager has to make estimation with regards to capital requirement of the business. Accurately estimating the capital required to start a business is necessary because running out of capital can cause business to fail as its early stage. So with thorough estimation based on sound assumption, the chances of cash downfall or losses may reduce.
Second, determination of capital composition. Once the estimation have been made, the capital structure have to be decided. It means this involves short and long-term debt equity analysis. This will depend upon the proportion of equity capital of a company is purchasing. In addition, which funds have to be raised from outside the parties. Third, choice of sources of funds. For additional funds to be procured, a company has many choices like first, issue of shares and debentures. Second, loans to be taken from banks and financial institutions. Third, public deposits are to be drawn in form of bonds. Meaning to say, this is important to know where else you can find funds quickly. It's better to have a lot of source so that we can don't focus on one thing once we get rejected. The choice of the factor will depend on relative merits and demerits of each source and period of financing. Investment funds. The financial manager has to decide to allocate funds into profitable ventures so that there is safety and investment and regular returns as possible. Investment products created with the sole purpose of gathering investors' capital and investing that capital collectively through a portfolio of financial instruments such as stock, bonds, and other securities. So, sinasabi lang naman dito na dapat kung may kakayahan ka na mag-invest, mas magandang mag-invest tayo. Hindi lang sa isang market. Dapat meron din tayong stock and bonds. Kasi kung nakapokus ka lang sa isa, high risk na mas maging lugi ka. Dapat balance. A good investment portfolio is a balanced portfolio or a balanced investment. Dapat meron kang stock market, meron ka din bonds to what ano ba to maintain the high and low risk. Kahit na sa isa is high risk and sa isa ay low risk na nagkakaroon ka ng profit sa kabila ay hindi, at least alam mong hindi ka talo because you're not focus in just one stock market or hindi ka lang nakapokus sa isang investment. Next, disposal of surplus. The net profits decision have been made by the finance manager. Is when a department disposes of equipment, material, and supplies, whether inventorial or not, through the established procedure facilitated by the surplus property department. So, lahat daw na i-dispose na gamit, equipment, and supplies is dadaan sa surplus property. This can be done in two ways. Dividend declaration. It includes identifying the rate of dividends and other benefits like bonus. Dividend is a distribution of company earning to its shareholders and determined by the company's board of directors. Dividends are often distributed quarterly and may be paid out cash or in a form of reinvestment in additional stock. So, sinasabi dito is nagbibigay sila ng incentive kapag maganda yung earning ng isang company. Pwede itong gawing i-transfer as pera or reinvestment in additional stock sa lahat ng investor or sa lahat ng shareholders nila. 2. Retained profits. The volume has to be decided with help defined upon expansional, innovational, diversification plans of the company. So, retain, from the word na sa retain, is panatilihin lang naman natin daw yung expansion and innovation of diversification ng pagpaplano sa isang company to gain high volume of profit. Next, management of cash. Finance manager has to make decision with regards to cash management. Cash is required for many purposes like payment wages, salaries, and payment bills. From the word itself, management, finance manager is managing the budget of different sectors like yung wages ng employee, salary nila, and payment of bills ng isang company. So, as finance manager, dapat alam mo kung saan dapat ilagay o i-allocate yung budget para maiwasan yung discrepancy at hindi magkaroon ng error sa isang kumpanya. The last function of financial management is financial control. The finance manager has not only to plan, to procure and utilize the funds, but he or she also to exercise the control over the finances. This can be done through many techniques like ratio analysis, financial forecasting, cost, and profit control. From the word itself, financial control, hindi lang siya nakapokus sa pagpaplano and paggawa ng rules and objectives sa isa loob ng kumpanya, but also to finance the entire budgeting of the company. Sinasabi din dito na financial controls is dapat may skills tayo na pagdating sa ratio analysis, financial forecasting, and alam natin kung saan natin i-allocate na mabuti yung budget natin. So, kapag nasa isang company tayo, dapat hindi lang same employee yung i-deploy natin sa bawat department. Like, for example, sa loob ng accounting department, iba yung taong naka-assign dito. So, tax department, iba din yung naka-assign dito. Para maiwasan natin yung discrepancy or dayaan or duplicate ng isang financial reporting. Kasi magandang i-handle natin ng properly yung nasa loob ng kumpanya natin para magkaroon tayo ng strength and alam natin CEO and the board of director na maayos natin ginagawa yung trabaho natin as a financial controls. Why is managing financial is important? First, help organization and financial planning and acquisition of funds. Second, aids organization effectively utilize and allocate the funds received or acquired. Third, support organization in making critical financial decisions. Fourth, help in improving profitability of organization. Fifth, increasing the overall value of organization. And the last, provide economically stability. So, ito lang naman yung ilang kasagutan kung bakit kailangan or kung gaano ka-important ang managing finance sa loob at labas ng kumpanya at sa ekonomiya. That's all. Thank you.